Let me just very briefly introduce Bénédicte Giafferri, who will actually introduce the panel. Bénédicte, you are Global Head of Real Assets Finance at Natixis CIB. I give you the floor to introduce the panel and also our speakers. Thank you.
Thank you very much, Christina. Very happy to be here with you all. Last year, at the same event, we had a real assets panel as well dedicated to the new paradigm of change in inflation and interest rates, which indeed was a huge change in our businesses. There is another one that was mentioned in all the panels before, the ESG and the way it drives our business. It has been changing slowly the way we were doing business over the last 5 to 10 years, but we are now coming to a point where it is a huge change again. We can see that there are many new ways to invest into ESG topics, in particular in the infrastructure side, and we will have high-quality panelists talking about it. I will come back to that. And also, for all debt funds, it is a requirement which is related to regulation, but not only, to have a very thorough analysis of the ESG aspects of each of the topics that are being financed, and this is also a complete change of paradigm. So we will have a panel which will be split into two parts. So one focused on the new type of investments that are emerging out of the energy transition, and they are huge, and we all know that energy transition is driving a lot of investments at the moment, as Patrick Artus was reminding earlier today. So we will have Remy Welschinger, co-founder and president of Viridian, which is refining lithium, and it's a very new lithium refinery in France, and this is part of the investments that have emerged very recently. Julien Touati, who is the CEO of Reed Management, a new investment manager focusing on energy, waste, and water sectors. And Julien is a specialist in investing into new types of assets. Isabelle Girardet, who is head of private credit investment and credit insurance at Allianz Trade, and who is also, as a debt investor, investing in new types of assets that not all of the debt funds are able to look at. So we think it's very interesting. And then for the second part of the panel, we will have Pierre Naudé, Chairman and Chief Executive Officer of nCino, which is, as you know, a platform of data, which will be mostly needed for the ESG data of the investments. So we will have the panel animated by Hervé Chopard, who is heading our partners and servicing team at Natixis, and who has created the Co-Lending Square platform with which we co-invest alongside investors in many real assets projects. And by Orith Azoulay, who is head of our Green and Sustainable Hub at Natixis, helping all the teams, assessing the greenness of their businesses, but also helping many of our clients in that exercise. So I will leave the floor to all these panelists. Thank you very much.
Thank you, Bénédicte. So we'll start with the first part. And I've been working on infrastructure space for the last 15 years. And ESG has always been part of infrastructure, but mostly through renewable energy. And we've been waiting a lot for new projects in to finance the energy transitions. We've seen a few, but we think that we are now at a tipping point, and we're going to see more and more of those projects. Looking at different studies, today climate spending is around 1.2 trillion. And coming back to what Mohamed said earlier, there's huge need, and depending on the estimates, we think that in order to reach the net zero in 2050, the current financing gap is between 5 and 9 trillion, on average between now and 2050. So it means that we need to step up climate spending from 1.2 trillion to 5 to 10 trillion per year. Basically, it goes in 4 sectors. The bulk of it is in transport, linked to basically electrifying the transport. So it comes with producing electricity vehicle, EVs. So the main difference is the batteries. So the production of the batteries and also the charging infrastructure. So this is the main part. Then low carbon fuels. So biofuels and hydrogen are the main avenues for now. Energy efficiencies and modal shift. So going to collective transport versus individuals. So that's the first bucket. The second bucket is energy. This is obvious. This is what we've seen. So it's 30% of the gap. Renewable is only a small part. There's other low-emission energy generations that and fuels that needs to be produced, and also a big investment in the electricity grid and energy storage. The third part is buildings, 24%. So mostly energy efficiencies and electrification of those buildings. And the last, which is the is industry. So a lot of those projects, they span, they are really transversal, and it covers a wide array of opportunities. So we started to see those projects, but it's true that more and more those projects, they don't really fall easily into one asset class. It's not really infra, it's not really real estate. It comes a lot with new business model, more merchant, and new technologies. So the question that we have trying to answer today, talk about it, is basically, are we finally going to see those projects coming? And do we think that investors and banks are ready to finance those projects? So turning to Julien. Julien was in charge of energy transition at Viridian for years. So Julien, what is your takeaway on the projects we have seen so far? And what project can we expect in the future? Do you think that this big wave of projects are going to come? And finally, do you think that there are more infra or real estate?
Your last word was interesting, real estate or infra, but I will come back to it. So good afternoon, everyone, and thank you for putting together this panel. Maybe to echo what was said in the previous panel, I think, and that was very clear in your introduction, Hervé, I think we are probably one of the sectors that will produce the highest share of basically primary assets, new assets. So this is good news for this industry in a way, as we were discussing, because it's always big. It's always better when the pie grows than simply having to fight for market shares. But it's also, as you just said, essential if we want collectively deliver this transition. In terms of experience that we went through over the years, so I'm starting this new company to go one step further, but I had a chance to spend, roughly speaking, 12 years on developing new things in this space, starting from in my previous life, from very complex topics such as how do you finance nuclear, but that's not for today. So we looked at specific segments, and that's something in a way you can afford when you are a private investor. You are not in the same position as the public authorities, which have to finance everything. You can pick the segments that are the most mature, the ones that may become investable. So the segments we covered included EV charging. We were the first to move in 2018 in that space, and I will come back to that later. Flexibility, which is an important word now in the space of electricity, the sector of electricity, but I don't know if everybody is familiar with it, but the idea basically is to be able to balance real-time supply and demand, and that's not easy. In particular when supply is becoming intermittent with renewables. In that space, we looked at hydrogen for stationary storage projects, which is, again, a segment which is not that easy, and biogas. So the lessons I will share now very rapidly, because I'm not the only one, basically they come from these very specific examples, which are part of the underserved segments that you were mentioning, Hervé. But again, we always have to keep in mind that each sector is specific. So energy efficiency, for instance, that you mentioned, I remember at the time of COP21, the IEA was calling it the invisible man. Very difficult to grasp and to understand. In a way, flexibility when you do demand response is a bit of energy efficiency, but not totally. So 4 points. How can you manufacture, and that's our role in a way as equity investors, investable assets. The first thing, you have to pick critical ones. And that's not the case of everything in the transition. Today, EV charging, for instance, is obvious. We need to have this charging infrastructure if we want to shift. But sometimes governments don't put the priorities in the right order, and as investors, in a way, it's easy to go for the low-hanging fruits, the ones which are really corresponding to critical assets. And again, not everything is critical. We can discuss hydrogen for mobility, for instance. Second, and it goes in a way with the first point, assess affordability. It's a very important theme, I believe. I think our role, and is of course to make money in the investments we make, but to make happen investments that lead to solutions that are affordable. And I think it's a key element, by the way, to the long-term profitability of your assets. And that's, given in an inflation environment, that's something, of course, that is becoming very important. Third, and I think some of the colleagues around the table will echo to that, how do you build a path to cash flow stability? And that's what thank you, Bénédicte, for your kind words in the introduction, but that was my favorite game. How do you make sure that eventually you can make of something that is a bit fuzzy in terms of business plan and business model at the beginning, something stable? So you engage with governments, you engage with private off-takers when you have such off-takers, and that's a path. You start day one with something that is not easy to finance, so probably equity with a very high return. And over time, and that's something we've been able to do with one of our co-panelists, you get something more stable in terms of cash flows, and of course the structure evolves over time. And the last point, which is also related with the previous one, is we have to find, as investors, as equity investors, as debt investors, as project finance lenders, where the value is. Sometimes it's not so obvious. When you are rolling out a large-scale infrastructure that is, for instance, composed of zillions of charge points, the value is in the assets, the brick and mortar, for instance, the connection to the grid, okay, but it's also in the capacity to operate all these things at the same time. And that's with a shift as major as a transition, which is an industrial shift in my way. This question of where is the value and who captures the value and when is actually essential, and it's a bit blurring the lines between debt, equity, and all the various products that we are very good at inventing. So.
Thank you, Julien. Before we go to the second part of the question, maybe I'd like to turn to Remy. Remy has been, has a wide experience, but recently has really tried to make such a transition asset come true. It's not really it's not really. It is enabling. So we'll come back to that in the second part. So it's more an enabling. So it's a lithium refinery. But I'd like to ask Remy to explain what is this project. Where do you stand? How long has it taken so far and where do you stand? And what are the next steps as a first step? And then if you could enter into the details of the business model and the technology you're using.
Thank you, Hervé. So at Viridian, what we do, we focus on building refining capacity in Europe, specifically in France, near Strasbourg. What we focus on is the refining and the converting of high-value lithium salts. So you have a lot of producers of lithium chemicals in Latin America, in Australia, and some other parts of the world. However, the majority of that supply does not meet the specification of the lithium crystals we need to put into the cathode of the battery cells to put into the EVs. So having refining capacity in Europe is strategic to allow the end user, whether it's the EV maker, the battery makers, or the cathode manufacturers, to have a lot more flexibility in the sourcing of their lithium chemicals, and then they bring it to us to refine to the specification they require. So that's the key aspect of what we're doing. The second aspect of our project is the fact that we work on a tolling basis, which is quite unique in our space. You see this kind of business model in many other industries, but you don't see it in the lithium space because you don't have independent refining players like we are trying to be in Europe. And so what that means is not only do you have the flexibility in terms of the sourcing of the chemicals thanks to bringing it to us for the refining, but you also have the flexibility from a commercial and financial point of view to switch between trying to find the final product from another producer or to actually have an intermediate product and then paying us to refine it. So that's quite a change in what we see at the moment in the lithium space. And that has consequences as well when it comes to financing the CapEx, which is coming up in the next few months. And at this stage, we are finishing the engineering with Technip Energy, who you guys know very well in the oil and gas space, and they're making a big push in the transition space, especially in metals. And we are finalizing our tolling contracts with counterparties. Some of them are public, with the battery project of Vercors in France. Some others are still confidential at this stage. And we are lining up as well all the permitting to arrive at FID in Q1, Q2 next year.
Thank you. So, if we just stay on the timing, so when has this project really started, and when do you think the first refined product will be out of the production?
So, if we can line up everything by Q2 next year, so that's all the tolling agreements being binding, all the engineering being to the level of maturity, which makes the bankers and the investors comfortable, and being fully permitted, we'll start construction in Q3 2024. And then by Q2 2026, we should be starting up, so after the commissioning of the plant, and then we give ourselves about 6 to 9 months to ramp up to steady state capacity. So we're entering our contracts with counterparties in Q1 2027, and we will be producing from 2026. But because ramping up can be a fairly volatile phase of launching a chemical plant, we might have one partner being with us during the ramp-up phase, but we might have to do it on our own accounts, which has consequences for working capital as well.
Thank you. Okay, thank you very much. So that's a very good example, I think, of a new type of project. And typically on infra, we would like to consider it as infra, but there are commonalities and differences as well. Maybe turning to Isabelle, all of those projects, we need to find lenders for that, so banks and non-banks. As a non-bank lender, can you explain your investment policy? What transition projects have you financed so far, and how did you get comfortable? What are the hurdles, and how did you overcome them?
Okay. Good afternoon, everyone. We are a fund for Allianz entities, and therefore our investment policy is aligned with the Allianz objective to be carbon neutral by 2050. Net zero asset owners are more than ever necessary today. Sorry, I'll get it closer. That's much better. Our own operations, P&C, insurance, and proprietary investments are the first in line to contribute to that. How does it translate in terms of investment policy, Hervé? It translates into guidelines that we have, a commitment to reduce high-emitting sectors in our portfolio. So, of course, you're going to find coal. I mean, Allianz started to reduce coal since 2015. So it's more oil and gas now. And we're even looking at electricity, utilities, steel, and automotive as sectors we would like to contribute also to reduce the emissions. How do we get comfortable with the transition project? Well, I'm going to join Julien on some of the points, as we've shared some experience. But maybe before I give you a bit more, I just want to highlight that in infra, we have a major role to play. I mean, it is estimated that 3/4 of the efforts we have to make to limit to 1.5 degree the global warming has to come from infra. Of course, as individuals, we all try to do something, but as asset owner, we have a main role to play. Now, those transition sectors, we're open to it. They are challenging. Some of the ones that were mentioned here to my left are on our list. Of course, the EV charging is one of them. Hydrogen was another one you mentioned, Julien. I would add gigafactories. That's fairly new also. We're starting to see some. And other sectors, as the ones you mentioned, that are less frequent, but are necessary to optimize operating processes in the industries. For instance, we've seen softwares, they're not really assets, but to optimize the waste in an infra, and you need data for that. So we'll come back to the data later, but that's the main point. So how do we do it? We take a deep dive into the new sector. We are fortunate to be part of a big group, so we have economists, we have sectorial analysts, and one thing that has proved very useful within the Allianz groups are the engineers that are available on some of the insurance lines. So that's how we get there. But it is a challenge every time we get to those sectors because our credit committees are not that familiar with it. So it takes a bit of convincing that you are not doing private equity, but you're still doing private debt also. You have to take market risks. We talked about EV charging. That's a huge market risk. You have to take technological risks. So sometimes it's adding up to the tab, I would say.
So how do you go to the finish line? I mean, is it ESG that is the main argument, or you manage to get yourself comfortable with really the true risk-return profile?
So ESG is always a good argument, but it's not the one that will convince your credit committee at the end of the day. All our deals are independently approved by our ESG office, and I think it's an important point because it's an independent party from us as asset manager doing this. But at the end of the day, you need a story. Like Julien was saying, you start with something where you need to show that there's going to be cash flows, that there are enough side, things that can make it doable, even though you have a number of higher question marks than you would have on a proven type of sector. I mean, it's easy to do an infra deal that's been done in a sector that's been running for tens and tens of years, where you have a track record. On EV charging, for instance, you have lots of question marks. The market is just exploding. Who's going to lead the market? Do you have the right sponsor? Do they have the right positioning, etc., etc.? And this is key because you don't have off-take contracts. So everybody likes the infra contract where you have your secure cash flows with off-take contracts, but we have them less and less in those transition sectors.
Thank you, Isabelle. Yeah, it rings a bell. So, Julien, if we come back to you, so you've been really incremental in creating those assets ahead of the curve. Now, this is the past. What I'm interested in is going forward. So, what is your view? I mean, do you think we're going to have, where do we stand in the creation of those assets? Where do you think they're going to come from? And do you think they're going to be, are we going to see are we going to bridge the financing gap? Are we going to see enough projects to face this challenge we have?
On the capacity to bridge the financing gap, I'm an optimistic by nature, so it's possible, even if I would not say it's proven. So, so if you bring me back to the oil and gas metrics. Now, joke aside, I think it's going to be challenging, for sure. And in a way, it's difficult to look at a very fast-changing future when you are a financial investor, because we tend to, as you just said, Isabelle, we tend to try to find what was a nice cookie that we were eating some years ago. So that's not easy. But I think we can be optimistic, because in terms, even if the current market environment, we still have a lot of liquidity. I think that's always very interesting to discuss with retail investors in the space. They really want to be exposed to that, and if you can offer something that is sustainable and profitable, I think you have a real selling point. So eventually, the the end users, the savers, are the one that should drive the way we think. But just to your question, because you asked it first, I didn't answer, and what's next? I think there is a lot to happen in adjacent sectors to the transition, where I see a configuration a bit close to the one I was seeing with EV charging in 2015. So for instance, waste to X, and in particular in the plastics recycling sector, there are a few things that are coming, and I have a fairly high level of confidence on our capacity to find the nice contracted cash flows we were looking for, but we will probably need also to think of structures to absorb some of the merchant risk before we ask lenders to, and including private lenders, to come. That's one segment. I think there is a lot to be done in relation with adaptation, and in particular in the water sector. I mean, for French people, I think now it has become obvious. I think, unfortunately, for Mediterranean people more widely, but not only. And there is a lot to do in that space. It goes with affordability, as I was discussing, but it also goes with changing the mindset, and that's one of the rationale that underpin our investment into Suez in my previous life. I'm still a director of this company, but there is a lot to do with irrigation as a service, even beyond traditional municipal concessions. So these two sectors, which are a bit familiar for infra lenders, but newer in the business models, waste and water, they are going to yield, I think, very interesting opportunities. In the energy transition, I think what has been very difficult in that space, as it's a changing environment, is that we tend not to have good convictions as investors, most of us. I think the first, for instance, around hydrogen, just after COVID, was positive because it helped to have new models emerging. But to a certain extent, some people got carried away, and eventually where hydrogen is useful, you mentioned the steel industry, for instance, as a feedstock, it's still difficult to have people being mobilized and financing these assets, which are actually the first one that should come rapidly, green steel and things like that. So this is also something on which we need to continue to work all together, and I like your point on the fact that you can rely on a very good team, people helping you to forge these convictions, beyond simply following the guy who did that and who's claiming it's wonderful, because we are very good in our industry at saying what I've done was perfect, until it fails.
Thank you, Julien. Maybe just to close the first part, I think we start to see the picture coming. Remy, if you try to put yourself into the shoes of an investor, what will it take for them to invest in your project?
No, I think it's been mentioned by my peers here. It's there's a technological risk. So what we do specifically at Viridian, they all reference projects in China and Japan. So in terms of technological risk, it's not that high, but it's new in Europe. It's new to bankers, it's new to private debt funds, and it's new to equity investors. So you have to educate to some extent, but there is only so much you can do. And so you're trying to use, credible firms like Technip to bring a level of engineering that gives confidence to the future stakeholders of the company. And the other aspect is to try to replicate the infra profile of our cash flows. It's not going to be the same. So to give you an idea, and we're benefiting from the advice of Natixis as debt advisors for us. But basically, the guys who've been financing oil and gas projects at Natixis are telling us, try to do as close to those guys as you can. To give you an example, the tolling agreements we're signing, the average term is about 5 years. And ideally, you'd like to push this to 10 years, really, so you can have a cash flow profile for repayment, which is easier to negotiate with the banks. So that's one example of it. The level of engineering, typically most projects in the mining sector get to a DFS, the definitive feasibility study, and that's supposed to be bankable. Nowadays, none of those bankable studies are bankable. And that's partly because of the lack of risk appetite from the bankers, but it's also because of the lack of risk appetite from the engineers from an EPC standpoint. And so we have now to push the engineering to a level of comfort and detailed that usually you wouldn't have to do, and now you have to do it to make sure you can get the right EPC contract in terms of terms and condition, and sharing as much responsibility and liability on the engineering partner or construction partner, and then having the banks and the investor a lot more comfortable about the liability you might carry yourself, which would likely be very dilutive on an equity point, but also risky from a debt point of view.
Thank you. So I suggest, Orith, that we stop here. I think we see the picture, lots of projects coming, but not as easy cookies as a raw PPP with availability contracts. And now the challenge, so that's the first part of the challenge. The second part is indeed to make the proper ESG assessment and the data monitoring.
Thank you, Hervé. And hello, everyone. I think we've reached a stage of the investment community where there is no proof to be made of the appetite of a number of investors in the space of energy transition, and I would say energy, capital, natural capital, and societal transitions. The challenge here today is the scaling up of it, and through scaling up, I'm a biased person because I'm an ESG natural since 20 years, but I have the conviction that the more you're going to be able to demonstrate, qualify the environmental and social benefits, be them from a risk perspective, and I put affordability or affordability within the risks, as well as from a enabling capacity. I think all of you are convinced that lithium is a key part of the energy transition value chain, but we all will feel much comfortable if we have a well-established, numbered approach to demonstrating from how much, depending on where, depending on the technologies. I know there are a lot of studies, but an established set of data helping us to make everybody account for risks and evaluate the contribution to transition is probably extremely needed. So in saying that, what I'm trying to lead us to is investors are there. There is an amount of capital, but we need to grow it, and we need to grow the amount of assets that are being developed. Green Deal, IRA, all of this is part of the picture for sure. NZBA or NZIA, NZOIA, all the NZs, if I can call them that way, are bringing together the financiers as well on the same page. And of course, the elephant in the room, the regulators, has made a very clear commitment, engagement over the last 5 years. And as it has been a lot the case in ESG, the first action lever they action it is disclosure. With enhanced disclosure, we're coming with the investment community categorizing funds, using or misusing those categorization as labels as a benchmarking tool. And when you start using disclosure as a benchmarking tool, then you can consider it's the anti-chamber of action. So what I can say is that at the EU front, the approach has been to address this ESG disclosure approach in an ecosystemic fashion. Banks, investors, corporates, all at an arguable sequencing, I would admit. We could admit, but it's been done that way. And now the challenge of disclosure is ESG data. We need reliable, comparable, opposable, relevant ESG data with the ability to cover all the matters I mentioned: risk management, transition potential, and green features, as well as the we have some maturity in some segments, but we don't have them in the private players. So what I would love to hear some of your views is really on how what's your actual need for ESG data, Isabelle? You've quickly laid out the big lines of the investment process. I know part of the demonstration of that investment process is ESG data related. So what's your need? Where are the challenges today in that front from your end?
I would summarize it in our field, and then I'll go into details. We need more. We need reliable data. That's very well what you said, Orith. We need data continuing in time to be able to monitor it. But to give you an idea, there is no standard, so it's difficult. On our side, we feed the data to the Allianz system, so we need raw data. I don't necessarily need something that comes and give me a rating or whatever, because we have our own platforms. We're talking about infrastructure private debt here, so you're talking about SPVs that are borrowing. If I start telling you I need scope 1, 2, 3 for the borrower, and that's just the first part. Then I need the share of energy that is renewable, non-renewable. The number of sites that are close to biodiversity or not. And then I go to the S, and I need information about human rights and gender equalities, and I'm still talking about an SPV here. So I can understand the challenge, but we have to fit at some point into a model, because as institutional investors, we aggregate the information, and there is one output at the end, which is the carbon footprint that we have and the emissions. So that's the main challenge, I would say, or it is how detailed is what we have to give versus what we start with. New sectors, lack of data, an SPV. I don't have a corporate that has a bond that is publicly traded and is publicly communicating on its scope 1, 2, and 3. So we need at some point the sponsors to help us to provide this data. Independently is always better if it's an independent source, but at least to have something. And we've been communicating this to the banks we're working with, because it's important for us.
Just as a follow-up, our heading towards ESG due diligence packages or ESG info covenants, is that the route that you think the industry is going to take their own fate in their own hands in a way, and impose that as part of the credit process?
I'm not sure I have the answer to that question. I think we have to wait and see how things evolve, but we need a bit of common standard at some point. And that leaves me...
But having a lot of investors every day on the line, I can echo their need. Many investors, and it was not the case 2-3 years ago, but now they've come at a point where they tell us, look, if we don't have an ESG due diligence pack at the beginning, we are not going to look at the deal. If we can't say easily whether it fits within the taxonomy, it's going to be difficult for us. And last but not least, the data reporting is such a hurdle right now. We want to make sure those are included into the info covenants of the finance doc. And I don't know, Isabelle, to what extent this is a deal breaker for you. I'm not saying it's a deal breaker for everyone, but I think it's going to be more and more important.
And yeah, it is more and more important, because we have to calculate the carbon footprint of our portfolio. So if we don't have the data at a minimum, it's difficult. At the moment, we do a bit of a proxy using a NAS code, and but then what we do is already complex to estimate, because you have a project. So do you use the revenue as the base? Well, if it's a greenfield, you have a construction period, your revenue base is volatile, so maybe not the best, and you want to use the assets. Okay, but then, so we already have complexity in the product itself versus, as I was saying, a publicly traded bond. So yeah, we need help on that side, because it's becoming more and more a requirement.
That gives me a very good transition. I think what sponsors have been saying as well, and I'm happy to hear your views, is they're observing that quest for additional information, but they're being swamped by questionnaires, unstandardized questionnaire that each investor has built on their own interpretation of what the regulation is expecting from them and what their own investment priorities are. We get to see those questionnaires, and they're same but different, not asking exactly the same the same question. Maybe Pierre, you can share with us a bit your observation on the ESG data front from investors that you have been witnessing, and what nCino has been working on over the last 2 years, I think.
Yeah, thank you for having me. nCino is a technology provider to banks. The company is 11 years old. We've got over 400 banks using our loan origination systems. And we have a firm belief that the collection of data has to happen at the point of origination, because that's when you make credit decisions. That's when the borrower are actually motivated to work with you to provide information. And I never forget what I learned as a young person in banking. The borrower only cares about two things. Am I approved, and when can I get the money? So it's very difficult to extract data and information at a later stage from borrowers. If you couple ESG data with your origination processes, they're more than willing to give everything. It becomes part of the credit process. It becomes part of the credit committee and decision processes. And we believe that out of regulation, as well as bank policies, will come standardized practice, procedures, and data collections so that your investor community can actually decide based on a credit score, just like credit, what those assets look like. And you can guide and judge them appropriately. What attracted us to work with Natixis is not only are we helping the bank to drive efficiency in the origination process, but also improve in the portfolio management, as well as syndication of these loans to drive standard practices and the way the bank is forward-thinking about standard methodologies and automating these processes. So we're working very closely with the bank to develop it in Europe. I can tell you that we are a global company across Asia Pacific, Europe, as well as North America. And Europe is by far leading the thought processes around what ESG will look like in the future. And as such, our development teams are local to tap into that local knowledge.
Maybe we can just say a word of what we've been working on lately together. So as many of you may have heard of, Natixis had for a long time their own internal evaluation model called the green weighting factor, which is allocating a color rating reflecting environmental and climate performance to each of our financing as part of the credit process. And as part of this, and I'll cut the story short, for real assets, we've developed a number of methodologies that we call internally decision trees that allow us per technology, I think we have 80 of them, to make an assessment of the climate and environmental performance from 2 dimensions. The scope 1, 2, 3, so what I would call induced emissions approach. Second dimension, exposure to non-climate environmental risks, such as biodiversity, water, waste, and pollution. And last, a notion of enabling. How do we valorize the transition enabling capacity of the assets or the projects we're looking at? So we had our internal IT development and first phase, and we've engaged with nCino very recently on developing a very systematic IT integration in our credit process of these decision trees. And as part of this second wave of projects, we've integrated and trying to be as 360 as possible. Carbon footprint evaluation, principal adverse impacts, so for all SFDR literate, we're talking about a number of PAI that we managed to extract from the decision tree, taxonomy alignment, technical screening criteria alignment, evaluation. So that is what we've been doing. We've been so you're not seeing, so you are. The type of PAI that we cover with the green weighting factor, so it's not obviously all of them, but it's a good share of them at asset level. And with nCino, it looks like this. I don't know if you want to elaborate a bit on the approach, but Basically, we've built a set of activity data that we want to get the originator to collect ahead of the credit decision, that are entered into the system. Then it answers a number of questions, our decision tree, which is basically getting the color to evolve from an average proxy of the sector to a very specific to the asset evaluation. And it gives you our internal color rating that only us really understand, but carbon footprint, taxonomy taxonomy alignment information, and PAI information. And that's something we are in the process of building with nCino, which I think is a big journey for both of us. But it's also showing how granular, tailored, sector and technology specific those assessments need to be. If you want to.
Yes, and I can just add to that, because I believe the natural tendency over time of borrowers as well as bankers as used to be, there's a portfolio management aspect to this, as well as covenant and collateral tracking. And this should all be integrated into that credit process, because again, that's what motivating the borrower to provide the information. So what we can see in the future is, as part of normal portfolio tracking and management, you have to look at how these data elements are changing and how they're actually impacting the ESG scores, because that's a very natural thing that industry or the practices can actually mature and change over time. So this is a living, breathing thing. I believe these models will evolve over time, regulations will evolve, etc. Again, Europe is leading the way there, and I believe we'll take this to the US as well at a later stage.
Thank you, Pierre. Just to move on, underlying what we're seeing is investing in transitioning or transition assets, if you allow me the expression. That means investing in green. That means investing in transitioning, i.e. reducing direct emissions, scope 1, 2, 3, and that means investing in transition enabling. And from a data perspective, for green assets, let's say we have taxonomies, EU taxonomy being the most used one. For transitioning activities, we have some elements to evaluate scope 1, 2, 3. For transition enabling activities, we have much less. I'd say the official data point would be what we call avoided emissions, but the avoided emissions require a model because you're avoiding against, super dependent on the technology, the geography, and the hypothesis of share of value chain each component comes from. And I think in that respect, both regulatory disclosure or the NZBAs are falling completely short of that aspect. But if we listen to all of you, it's the core of your investment thesis. It's the core of the types of technology you're addressing in your investments, with the underlying assumption that it is good, it's relevant to the transition. I think we're reaching a point where we need to demonstrate it in a very quantified manner, and it's still a bit falling short of what we have at hand. So maybe Julien and or if you could share with us how you how do you handle these ESG data issues? How do you see them as a compliance topic, or do they actually inform your investment process? And if so, to what extent?
I think you said the most in a way. With the new asset manager we've been putting together, we are in a fairly easy position from that perspective. We are native in a way to transition assets. So, but we have to demonstrate, and I will come back to that. But in a way, so for us, it would not make any sense not to fully include these aspects in the investment process, ESG and impact, and demonstrate that the investments we make, because I think over the long term it will be a condition to actually profitability, are sustainable. So I think when it is more difficult, it is when you have a legacy portfolio that you want to transition, which is the case, for instance, of massive lenders such as Natixis. But in our case, in a way, everything is easy. We put together a framework, we take the most advanced. The only thing we pay attention to is not to be too constrained. In particular, if we can really demonstrate that something is extremely impactful and is not making significant harm, we don't want to be stuck simply because in a given legislation somewhere somebody considered it was not eligible. Which goes to your point, and that's what we are building now with a specialized advisor I really liked in my previous slide, so I decided to mobilize them here. You need to be able to quantify, to demonstrate, and you need to convince your investment committee on both sides. So the thing, the Rubicon I'm starting to cross is not only to look at the IR and value creation from a financial perspective, but also look at social return on investment. With this underlying idea that both should go in the same direction, and if you, for instance, if you finance a chemical recycling facility for plastics, and eventually it happens that you have a negative impact more widely, or you don't have a high enough social return on investment, how on earth can you justify that brands, Danone, people like that, will accept to pay a premium on your plastic compared to virgin plastic? So for me, in the space where I play, given the strategy that we have, I'm in an easier position. But your point, demonstrate, not only tick boxes, being able to, I would say, look at using the ESG and impact aspects, look at your transactions through different angles. And I've seen in the past, to take a concrete example, a very obvious project, a tramway, which was, everybody believes a tramway is super good from a pure ESG perspective. And actually, when you looked at the scope 1, 2, and 3 of the tramway over 50 years, so very long term, it was negative. You will never recover the initial investment in carbon corresponding to construction. So looking at all these indicators is also a way to inform your investment, because if you claim that it will be supported over the long term by your client because it is green and it's not so green, for instance, you may eventually lose much more than your compliance aspects, which are key, but you may lose your money as well.
Thank you. Maybe Remy, it gives me a good transition, which is lithium. I'm not even arguing for a second the role in the transition value chain, but I'm quite against the idea that some have conveyed that lithium is green. I think lithium is not a green asset. It's a transition enabling asset, but it bears with its extraction and production a number of impacts. And I'd be interested to see how early on and what's been done by Viridian to evaluate its environmental impacts throughout the value chain, as well as providing the demonstration of its avoided emissions power in the various downstream markets.
Yeah, sure. So look, but lithium being green, nothing is green, right? So if we want to live in a green world, we stop doing anything.
Exactly.
All right, and we buy second-hand stuff. So nothing is green. When it comes to lithium, just to be very clear, a battery has about 13% of CO2 emissions coming from the lithium. Exactly. So it's one of the top 3 delta when it comes to the footprint of a battery cell. In terms of how do we go about it, it's quite simple for us, specifically being a refiner, because we're not responsible for what's coming into the plant. The client on the downstream side is responsible for it. The second aspect is we have regulation in Europe, which I believe is the strictest in the world when it comes to battery cell CO2 footprint. So you have a methodology which everyone has to follow. In our discussion with OEMs, car manufacturers, they ask us very early on in the discussion to give them ISO compliant life cycle assessments. And now you have a few relevant firms, consultants, which are being used by the OEM themselves, by the battery makers, and by us. And we all go through the same ISO compliant methodology, and you have your number. Our activity is quite transparent. We have a lot of engineering, so we provide heat and mass balance data. We provide utility consumptions data, and that's all you need to know. And that's enough from a CO2 footprint. Then all the other aspects of ESG, it's relatively simple for us again. We're a French company in France with a certain number of employees, and so there isn't that much actually to worry about beyond the CO2 footprint of what we're doing. So what really matters, and that's the key part when you talk about enabling, that's exactly what we do. So if you're the OEM or you're the battery maker or the cathode manufacturers and you're trying to source lithium, having access to our plant allows you to focus on more compliant assets from an ESG point of view. Right now, when you want lithium hydroxide, which is really what we favor in Europe due to the chemistry we've chosen, higher performance, higher range, for the batteries we'll put into an Alpine, for example, or some other vehicles. The lithium you need right now is coming from hard rock resources, which goes through pyrometallurgy, similar to what we see in the cement industry and the steelmaking industry, and that's very high energy intensive. So if we believe hydrogen will help our kilns at 1,000 degrees Celsius anytime soon, I don't believe that. But if we believe that's going to happen, that's fine. But in the next 10 years, we need to find different sources of lithium that we can still transform to lithium hydroxide, which is what we need. And that's why we're the enabler here. Because you can get lithium carbonate, which has a much lower CO2 footprint, and ask us in France, plug to the electricity grid, which is very low CO2 as we know, to then transform it to the right spec.
But the footprint would vary very much depending on the grid. Maybe to close, Isabelle, it would be interesting to see how the carbon footprinting and maybe, if any, what we call scope 4, but that's the avoided emission aspect has penetrated your investment approaches, and to see, what do you do with that CO2 footprint data? Is it a reporting data only, or are you making investment decisions depending on your net zero targets at group level, which has some reality, I would imagine, on your fund? So what's the reality of these data in your day-to-day?
I guess it's for me. All right. At the moment, the answer is no. We are working on scope 4, but it's not integrated yet. At the moment, it's 1, 2, 3, and yeah.
And on the 1, 2, 3, and on the current carbon footprint, is the industry reaching the point where your overall targets are you reverse engineer in your investment decision your overall net zero targets?
Yeah. Well,
in other words, as Julien is saying, are you building a carbon budget?
Yeah, a carbon budget. I think we are going towards it. I can feel it coming. We don't have it yet, but no, it's probably coming, yeah. And it's in our mind. I mean, the credit committee, as I said, won't decide only on the ESG, but the investment committee will, and even the credit committee, it's a big part of it. If it doesn't tick the boxes, it doesn't go into it. We're not there yet, but I think it's getting close to it, yeah.
Maybe Julien, just from your end.
Again, I think the situation of an independent asset manager is a bit easier from that perspective. I would say that carbon will be clearly one of the easiest things to monetize and integrate in an SRI that we are trying to develop, this social return on investment, social with a broad sense of its society, so also of course the E in it. So the question of the constraint we will put ourselves in terms of carbon emissions, that's still a debate. We have not totally settled on this. Eventually, if we go for that, and that goes with your slide that was just passed on the scope 4, I think we will need to look at the scope 4 in particular, as I see the future of the firm we are putting together in enabling activities. Because if we don't look at the enabling activities, there is nothing at the end. So, and I think Scope 4 in this respect can be extremely powerful to look at these activities differently.
I'm seeing the timer in red, so I'm just going to thank you all and maybe just mention and bring to your attention an initiative which I think is very valuable to track, which is a consortium of investors led by Mirova and Robeco, to which we as a CIB have joined, to create a avoiding emissions factors. So basically, the same way we have emission factors for all sorts of technologies, embedded into life cycle analysis databases or embedded into ADEM or all sorts of providers. Here, it was a call for projects to build first an open access, technology-based, geographically based, value chain distribution based to avoiding emissions factors. And then a second part, which is for data providers to use them and provide the evaluation on assets, be them corporate. So I think it's really meeting at least the need, and it's an interesting initiative to track, I think.
Thank you very much. A great applause to all of you. Thank you.